Welcome investors to the monthly equity outlook from Canara Robeco. When we actually think about equity markets today, we have to actually uh, kind of form a perspective about the global macros, which have become more and more critical now. Also, there is a geopolitical event that is developing, so it has become even more critical from near-term perspective. Second, how the domestic macros and micros are moving. Third, how the underlying earnings growth is panning out. And lastly, how our portfolios are positioned in the context of valuations of various asset classes, be it large cap, mid cap, small cap. So these are the four aspects that we will try to cover in next 10 minutes. Let us start with the first aspect. Global macros have been complex for last 2-3 months. I think that complexity has only gone up in last 1 or 2 months with two or three key events. One, the US yield rate yields have moved up by about 100 basis point in last 2 to 3 months. Second, the oil prices have, while they were looking like they are correcting, with the production cuts and supply chain challenges, they have again moved back to $80, $85, $90 now. And third, the Israel-Palestine conflict, which has emerged last week, which clearly has a potential to create challenges from energy cost perspective, which is always a key risk from Indian equity market and Indian growth perspective. So if you look at them one by one, and if you look at the cumulative impact of all these events on our market and our economy, there are two or three fold impact, part of which is ongoing, part of which is new. One is clearly in US, the growth has been surprising. As a reaction to that, the interest rates are likely to remain elevated for longer. That's the indication that is coming from Fed. Clearly, the market has not seen the impact of the past increases, but since the inflation and growth are surprising at the margin on positive side, it's been difficult for Fed to actually indicate anyway a decline in interest rates even in foreseeable future, and that is keeping the environment quite complex, which only means that while the growth in near term still looks very, very healthy in US and all, the cumulative impact of all these interest rates will eventually show up in growth. So from growth perspective, US eventually will moderate. That's also the objective of the policies. You have Europe, which is in recession. You have China, which is kind of not doing as well as people were expecting post COVID opening up. And the cumulative impact of all these things is the global growth is moderating. The moderation of this growth is showing up in the export data for most of the countries, including India. So the key takeaway number one is basically your global growth is slowing, and as an outcome, your export growth is slowing, which clearly means the sectors like commodities, chemicals, IT, and other exporting sectors will have little tougher intermittent challenges at least. So that's one. Second is in terms of the capital flows. If the interest rates remain elevated for longer, and the US yield currently is at something like 4.8, there is a huge opportunity cost for investor to go to emerging market. And what it means is that your capital flows, FII flows, which were hitherto positive for last 6 months, initially the view was that basically you are going to have a environment where cost of capital will start moving down, which means the interest rates will start moving down, but it has gotten delayed. So you are receiving capital flows. We received something like almost $20 billion in last year or so. Now you are in an environment where probably the flows will be more heterogeneous. While our domestic growth has not gotten challenged yet, but at that kind of cost of capital with that kind of interest rates, clearly there is little incentive for FII to keep pumping in money at the valuations where particularly India is as compared to other emerging markets. So that's second. And third is how these Israel's or Middle East conflict shapes up, because already OPEC and Russia has been controlling the production of oil, and thus the oil prices are at a significantly higher level than what fundamental growth justifies globally. And if there is additional conflict, if that extends to other parts of Middle East, which is particularly Iran, I think then you are going to have a challenge on the energy cost side, which hitherto is not there. The base case still remains that your energy cost will be lower 6 months down the line rather than being higher. But if this conflict extends, Then the CAD, which has been very comfortable at below 1%, you might have start a little bit of a challenge on the external front, which is your CAD will move beyond 1% or 1.5%, and at the same time you will have FII flows which will not be so constructive. Having said that, of course, the fixed income flows will partly compensate it starting the next financial year. So those are the three key takeaways from global macro side. One, the growth is slowing down. It will keep showing up in the export oriented sectors in all emerging markets including India. Second, the cost of capital is elevated. It is likely to remain elevated, and thus the growth is slowing down globally. So there will be, from a global investors perspective, there will be risk of, and so to that extent, your FII flows, which were hitherto till last month extremely positive, will be more heterogeneous and marginally negative at the from a next 3-6 months perspective. And third, basically, you have the capital and current account, which can get little more challenged than what it is today if the energy prices event escalates in the Middle East. These are three key takeaways from the global macro perspective for Indian market and economy. Now let us discuss the domestic economy. I think the domestic economy remains in extremely healthy shape. So the contrast is very clear. If you look at the domestic macro from all perspectives, you look at inflation, which is still not out of control, although it is little higher than what RBI would want, but it is still benign as compared to what is happening globally. You look at the current account, you look at the currency, you look at the tax collections, you look at the GDP growth number. Most of the macro parameter, when you look at them, except fiscal deficit, which is still relatively elevated, I think the macros are remain in fairly good shape. There were worries around tax collection, but even those worries seems to be kind of not right, given the tax collection numbers that lately have been reported. Our direct and indirect tax collection still remains healthy. So from macro perspective, largely the macros remain still in a healthy shape. The growth is projected to be about 6.5% this year and probably 5.5-6% next year. So growth still remains elevated as compared to the slowing down of in the external part of the world. The differential is very stark. We will have 10-11, at least 9.5 to 10.5, 11% of nominal GDP growth rate, as against the world, which will actually slow down significantly in terms of growth profile. So domestic macros remain strong. When you look at the key changes that we have seen over last 3 years and over last probably 5-7 years, when you look at it from government's perspective, 2 or 3 key things that stand out is, after very long period, you have corporate and bank balance sheets which are in extremely healthy shape. We haven't seen this kind of balance sheets probably since 2006, 7, 8. That allows the corporates and banks to take little more risk, which also means that the corporates will actually continue on their path of OPEX and CAPEX at the margin, depending on the external environment and capacity utilizations of respective sectors. And there are banks which are willing to actually support both the CAPEX as well as the other part of the economy, which is consumption. And that's where the credit growth still remains very healthy. Coming to the consumption part, consumption is resilient. Of course, not as strong as the investment part of the economy is doing currently, given that the investment part of the economy is coming out of a cycle. The only part which, from a domestic macro perspective, which is moderating and which is likely to remain probably a little slow for some time to come, as I said earlier also, would be the exports part, where clearly month on month the export numbers have been slowing down. So macro remains extremely healthy. You look at all the 4 or 5 key pillars of the economy. Consumption is steady, not necessarily good, but steady. Investments are doing fairly well. Most parts of the investments, be it government capex, the PSU capex, the private capex, which is just starting to show up, the China plus one related actually capex that is showing up, the PLI related industries where the numbers have gradually started improving. So there are a lot of ecosystems on the investment side which continue to fire till now. It is showing up in the order backlog or order intake on the industrial stroke investment side. Third, the government capex, as I said, remains healthy. Fourth, the exports, it continues to moderate. And fifth, which is the banking and corporate balance sheets, I think they remain extremely healthy. That allows the economy to actually go into a cycle. Typically you have business cycles which are initiated by public capex, and then they over a period of time translate into private capex. I think we are in that transmission at some point in time. If nothing untowardly happens on the external front, over next 1.5 years, gradually the private capex should keep remaining resilient and at the margin start improving. So all in all, the domestic macro remains constructive from structural perspective. We think that given where the corporate balance sheets are, where the bank balance sheets are, where the government's intent is, and government's capex is, it looks like, and where the credit growth is, it looks like you're in a business cycle, you're in a clearly in a credit growth cycle. The largest component of the economy, which is real estate, is also shaping up fairly well. uh, Real estate is almost 30% of the economy, and thus what is happening in that sector becomes very, very critical from a business cycle perspective. So domestic macro remain extremely healthy. Coming to the third part, which is how the earnings are shaping up, where the earnings are and where our portfolios are overweight, underweight. The earnings buckets haven't changed significantly over last 3-4 quarters. Still, uh, as it is in on a top-down basis, the earnings are still very, very healthy on the domestic cyclical side. The earnings are little complex or challenge on the external front. So when you look at the sectors, the financials, the industrials, the consumer discretionary, the auto, healthcare, your domestic pharma, hospitals, hotels, telecom, all these sectors continue to show resilience or earnings upgrades cycles. Whereas you have on the external front, basically IT, commodities, uh, chemical companies, where the earnings have either been downgraded or at the margin have remained where they are. So that's the situation of earnings. The earnings for financial year 24 are likely to be 22% for Nifty, and for financial year 25 it is estimated to be about 14-15%. uh, the financial year earning 24 looks very, very high 22 because of the base effect, because 23 was fairly low at 10%, and there is a margin benefit that first uh, kind of half has shown up. Having said that, whichever way you cut it, still the earnings growth fairly healthy, at least 13 to 15% CAGR for next 2 years also. As you go to broader market, there are pockets where the earnings are healthy. There are pockets where there is a lot of exuberance, but the earnings are not necessarily that healthy. So that's the earnings profile. Uh, as the one point to be highlighted is that the earnings profile will at the margin start actually moderating as you go into second half, because a lot of margin operating margin benefits which were available in the first half for sectors will not be available in the second half. So necessarily FMCG or IT or energy has to do well for earnings to kind of keep getting surprise on positive side. Otherwise, earnings would be about 22% and 15% for next two financial years. So that's where the earnings are. Likewise, our portfolios still predominantly remain overweight in financials, industrials, consumer discretionary, auto, telecom, hospitals, hotels, domestic pharma. These are the places where the portfolios are overweight on, and the portfolios are generally marginally underweight IT, and sizably underweight basically energy and commodities. That's the portfolio positioning. And given that there is a domestic cyclicality in the earnings, the domestic economy is in the upturn, the domestic credit growth and earnings growth is likely to play out over next 2-3 years. Of course, we are going to have election events, so that will also determine the intermittent direction. But that is where the earnings are, and that is where the portfolios are overweight on. Coming to the valuations, market are trading at something like 19 time financial year 25 earnings, in a fair zone as far as the narrow part of the market is concerned, which is large cap and top 150 stocks. But as you go down the market cap curve, there are a lot of pockets in market where there seems to be disproportionate amount of exuberance as compared to earnings growth, and to that extent, we would caution investors against kind of aggressively going for near-term benefits in that part of the market. Yes, there is a lot of wealth creation that happens in all parts of Indian market, but from a near-term perspective, from 1 year's perspective, given that the energy costs are elevated, there are some of these global risks, and there is a domestic political event calendar for next 1 year, we would advise people to be little more cautious in the broader part of the market, particularly the liquid part of the relatively liquid part of the market, which is the small cap, and would advise investors to actually gradually allocate, even if they want to allocate in small cap and mid cap, allocate it from a 3-5 year perspective rather than near term gains perspective based on what is happening in market. If one has to go lump sum or aggressively, one should actually look at risk reward, which is relatively more favorable, particularly in large cap, flexi cap, large plus mid kind of categories, diversified categories, as compared to the broader market cap categories, which is small cap and mid cap. This is outlook for equities for this month. We'll come back next month again. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.